Chapter F17 covers financial statement analysis, ways that companies can look at their financial statements and the financial statements of other companies to do an analysis to determine some kind of information about the company's performance. What is the rationale for this? We're going to compare. The bottom line is that financial statements analysis is a comparing of two different things. What happened to your company right now versus something else. Well, what could that something else be? It could be your own company's performance from year to year. It could be your company's performance against the performance of one of your competing companies, one of the companies that operates in the same industry that you do, that's your biggest competitor. Or it could be the comparison of your company's performance versus the companies in the same industry as you as a whole. So like Pepsi versus all soft drink companies. Doesn't matter what thing you're comparing against, the steps, the procedure to do an analysis is exactly the same. There are different ways that you can do this. The big three that you're going to cover in this chapter are a horizontal analysis, a vertical analysis, and a ratio analysis. A horizontal analysis is a comparing of something from year to year. So how did our company improve from the last period of time? Did we make more revenue? Are we incurring more expense? Are we taking on more liabilities, etc.? It's a comparison of last year's financial position versus what's currently happening right now. A vertical analysis is a way to break down your financial statements to figure out what portion of something else is a certain account, what portion of your current assets are in cash, what portion of your total liabilities are long-term debt, what portion of the revenue that you did went towards paying a certain expense like cost of goods sold or salaries, etc. So vertical analysis is breaking down your financials by how a certain number got made up. And then lastly, we have ratio analysis, which is a much broader realm of study. There's certain very specific questions that you're going to have. Are we paying out enough dividends? Are we spending too much money to make goods that we turn around and sell? In other words, are we making enough profit? For each one of these questions that you could have, there's probably a ratio that you can use, a formula, that's going to help you obtain that information. So ratio analysis is a bunch of different formulas, and each one of them is designed to give you a very specific point in information about the company's performance. Let's start with the horizontal analysis. We make decisions based upon our trends. We will look at our company and have a long-term goal, 5-year goal, whatever you want to have, that we need to increase our profitability. Well, we would then track it from year to year to year to see if we are, sticking to that plan, if we're following that goal. And the reason that you do this is because a number in itself, in isolation, doesn't mean much. Sales revenue, for example. If you had $1 million in sales revenue, and is that good? Well, that's a question you can't answer from just that number. You need something to compare it to. If last year you did $3 million in sales revenue and this year you only did $1 million, it's terrible. Or vice versa, if last year you only did $100,000 in sales revenue and now you did $1 million, well, that's a great increase. And beyond that, there's other accounts that you can have that you compare to that particular figure. So sales revenue, if it went up, is probably a good thing. But what if your expenses went up at an even higher rate than your revenue? Well, then your overall profitability lowered. So that might not be a grand thing. You might want to compare the rate of change between two different accounts in there. Same thing's true. You can have your revenue increase greatly, but why did it increase? What if you're making sales to a bunch of new customers and some of those don't pay you? If you had an increase in receivables that's at a greater rate than the increase in your revenues, it means you're doing a larger portion of your sales on account, which might lead you into a position where you have cash flow issues. So a horizontal analysis, we're going to study in the terms of percent changes how one line item, one given account, changed from last period to the current period. And how you do that is basically you always find the amount of change that you had during the period, and then you divide it by the prior period amount. So in this case, we've got Smart Touch Learning. They went up by $55,000 in sales revenue from $803,000 to $858,000. Again, the dollar value by itself could be useful, but it's not as useful as a percentage, because a percentage is going to let you compare to all sorts of different entities. We talked earlier that you want to compare to your industry as a whole. If you're a small grocery store and you had a $55,000 increase in revenue during the year, it's probably pretty good for you. If you're Walmart with literally thousands and thousands of locations and your revenues only went up 55 grand, it's probably not such a great increase. But a percentage is a percentage. A 6% increase in sales for a smallest business to a huge corporation is still a 6% increase. So for us, what we're going to do to find our rate of increase is take the amount of change, 55,000, divide it by the current period or the prior period amount of 803,000, and then convert it to a percentage. Yes, we can say the sales revenue for Smart Touch increased by 55 grand, but it's easier to compare to other entities if we say sales increased by 6.8% during this period. And that's the formula right there. If you want to throw it into a thing, just take the amount of change that you had, divide it by the prior period amount, and to convert it to a percentage, you can put in parentheses, multiply by 100, and it gives you the percentage rounded off. These things are usually expressed in the terms of a percentage to the tenths place. So this might not be exactly 6.8%, but it's rounded off, going to be expressed as 6.8%. And you can do this for every single one of the line items that you have on a financial statement. So let's start with the income statement. We have all of the different things that we have that goes into ultimately determining what our net income is, what our revenues were, how much we paid to either produce or acquire those goods that we sold, and what our margin was, profit margin, all the expenses that we had to pay that are part of our normal operation, our selling and administrative expenses, all the expenses and revenues that we had that were outside our normal realm of operations, and our taxes. Like, we had all of those different inputs in here. Well, how much did they change during the period? And now we can compare and change compare the different accounts changes to find some meaning right here. Revenue went up by almost 7%. That's pretty good. But because our cost of goods sold didn't increase at the same rate, that also didn't have an almost 7% increase. We see that our profitability, gross profit, is way, way higher than that increase that we had in revenue. So again, a number by itself only tells so much. Expressing it as a percentage and then comparing it to other accounts percentages lets you really break down what's going good or bad with your company. For us over here, that seems to be the reason that our profitability increased so much, is that we found a way to increase our revenues at a much greater rate than the cost it took us to acquire that inventory to help us generate those revenues. Looking down at the bottom, I see that we had a massive increase to our interest expense during the period. Well, that might mean that we took on a whole bunch of new loans, and we are going to have to pay out a whole bunch of money to finance those loans. So we're definitely going to want to make sure that this gross profit that we have is actually turning into cash that we're going to have to finance those loans with. And you can check that out on the balance sheet. It's the same concept. All you're doing is finding the difference between last year and the current year, taking that amount of change, dividing it by the prior period amount, and then converting it to a percentage. So how did our accounts change? We did a bunch more revenue, and we know that. It's looking right here, like of that bunch more revenue that we did, it's not getting converted into cash right now. We had a huge spike in our accounts receivable, increased by 34%, while the actual amount of cash we have on hand went down, which means those sales that we were making to increase revenue are largely on account, and we have, at least right now, not collected them yet. How did other things change? Big increase right here to our PP&E, which means that we are reinvesting in the company to get newer machinery, to upgrade our facilities. Maybe we even built a new plant, and that should help us be profitable in the future. But because we had all that addition right here, we had to finance it somehow. Did we finance with cash? That declined right there, so it's a possibility, but it's looking down here like I found the real reason. We got this extra increase in our PP&E because we took on a bunch of new long-term debts and even short-term notes payable. We had a big increase in our liabilities right there. So comparing your different accounts to one another helps you determine how your financial position is changing. For Smart Touch Learning, this is how our financial position is changing. We have a whole bunch of extra receivables on here, which we're hoping to collect soon because we're going to need money to have to finance all this additional debt that we took on. So comparing from one year to the last is always a great thing to do, but sometimes if you do it over a period of time trying to meet a long-term goal, it can present the information in a way that makes it look a little different than what's actually happening. So for example, let's try doing a trend of our revenue over time using trend analysis. It's the same exact concept, but instead of now always dividing by the last year every single time, we're going to pick one year to be our base year. And we're always going to compare the amount of whatever we're going to do revenues right here to what it was in that base year period. So over here, we've got a trend analysis going on right now for Smart Touch's revenues. We see how much they were every single period. But instead of always comparing them to the last year, so 26 to 2025 or 2025 to 2024, we're going to compare them to the base year. And our base year right here is going to be 2022. So what do these percentages mean down here? They are what percent of revenues you made during that year as compared to what you made in 2022. Revenues in 2023 were only 99.7% of 2022's revenues. Revenues in 2024 were 104% of 2022's revenues, so on and so forth. So for each year, we are expressing our revenues for that period as a percentage of what it was during the year that we declared to be the base year, using the same exact formula that we have been using, but not using the current or the prior period amount, but the base period amount. And let's visualize this right here. That's the information we had to work with. When you look at a graph right here, as a trend over time, just looking at the line, we see that there is a steady growth in Smart Touch Learning's revenues. We had a little bit of a blip right here in the beginning where it dropped slightly, but ever since then we've been going off at a fairly steady rate of increase. So if our goal was to increase our revenues over a period of time, this chart certainly makes it look like that is what's happening right now. What if I did the same thing, but instead of doing it against the base year, always comparing to the 750,000 we had in 2022, I always compare it to the prior year. Well, now look at my chart. It looks very jagged, up, down, up, down. Using a trend analysis will help smooth out the returns that you get and let you look at something over a longer period of time. So trend analysis is incredibly useful if you are not looking for what has just happened immediately, but the bigger overarching trend in how your company's financial position has been changing over a period of time.